Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The market is up big of late, but that doesn't mean there's not buying opportunities. And there are three stocks that really stick out to me right now as great buying opportunities for companies that I think are going to be very disruptive long term. Those three stocks are Spotify, Peloton, and General Motors. There's really a lot to like if you know what's going on at these three companies. So that's what I want to dig into today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you want more on these three companies specifically, I'll put a link in the show notes to spotlights that I did on each of these stocks. Really broke down exactly what their future looks like in a long and detailed article. So I think you'd enjoy that. And that's on Asymmetric Investing. I'll put a link to that in the show notes as well. So let's start with Spotify. And I think Spotify is one of the really interesting companies in tech right now because it's really at an inflection point. The music business has become very mature. I don't think there's a lot more upside the company can get from music from a gross margin standpoint. Profitability is going to be capped because Spotify doesn't own the music that you're playing when you're in the app. So it's not going to be able to generate a tech type margins in that 60, 70, 80%. But music is really the way to get people in the door at Spotify. And the future for the company is really podcasts and advertising. I want to start with podcasts because I think this has been an interesting journey for Spotify. The company signed a number of exclusive deals starting in 2020, acquired The Ringer, Gimlet, Anchor. The idea here was really to build out the tools and the network that creators needed to build their own podcasts on Spotify. The exclusive deals just tried to bring people onto the Spotify app from some of the competitors. That has been successful, and now Spotify is the number one podcast app. So number one for music and number one for podcasts. If your strategy is to own your ears, which that's what Spotify is trying to do, those have been successful moves. But now the next phase for Spotify is increasing profitability. That includes bringing more advertising onto the platform. Ads should be a relatively high margin business for Spotify. That hasn't been the case in the past, in part because they're putting a lot of those exclusive podcast deals. The cost for those deals go into advertising. So that kind of mutes the likely margins that we see in the advertising business. And then Spotify hasn't really focused on its place as the discovery medium and the monetization medium for creators and listeners. The best place for Spotify to be is the place that listeners are going looking for music or podcasts. And therefore, it's the place that creators need to be and the place that can help them make money. That's what we have seen shift over even just the last few months. Some of the strategic moves that CEO Daniel Ek has made has really focused on Spotify becoming that discovery place and the monetization place for creators. So I think there's going to be a lot of improvements in the app experience and in the monetization for creators. So I think there's going to be a lot of improvements coming on the app side. There's a ton of momentum on the listener side. So increasing the number of premium subscribers and the number of free subscribers. That's like growing the top of the funnel for Spotify. And so ultimately, long term, that's going to make its way to the bottom line. I think that's really great news for Spotify, is the kind of stock that I want to continue to add to and hold long term. Peloton is obviously a company that's been beaten up over the last few years, was one of those pandemic darlings, but now it's gone through a massive shift, made a lot of mistakes, buying up a hardware manufacturing company, building out too much inventory, and having costs that were just not sustainable because hardware demand wasn't going to be growing in the way that it was during the pandemic. But as investors, we're not buying the stock at the price it was trading for in 2020 or 2021. We're buying the stock at where it's trading today. So we need to analyze the company that we have today. And I think there are a few really great signs for Peloton. One is that the company continues to add subscribers quarter after quarter. This may be surprising, but Peloton has actually grown its subscriber base every quarter since before the pandemic started. So people are not dropping off of the app because they're going back to work or going back to a gym. They're actually keeping that subscription. And at only $44, it's actually pretty reasonably priced compared to hundreds and even sometimes multiple hundreds of dollars for a gym membership. And that gets to what the company has done in the last month, which is announced more subscription options for the app. So this is people who want to use Peloton subscriptions. They have 18 what they call modalities, or basically different workout types, including running, boxing, lifting, yoga, all kinds of different things you can do in this app now. And so as they're building out this digital app ecosystem, you want to deliver that digital content to as many people as possible. The app, which doesn't require Peloton hardware, there's a You can have a free subscription. There's a subscription that's about $12 and one that's about $24. So that gives 3 different price points for Peloton to attract users who want to be in the Peloton family. And I think that's going to be something that allows them to grow that user base and eventually grow margins over time. This is a digital streaming company. So Peloton doesn't need to maximize the dollars per user. You actually want to maximize the number of users. There's 3 million paid users right now on the connected fitness app side. That's the premium $44 price. There's about another million users on the app side. So if we start to see Peloton reaching 10, 12, 15 million users over the next decade, that's really where you could see this stock be an absolute home run, because each marginal user doesn't actually cost that much for Peloton to serve. It's going to be a lot of incremental margin if they're able to grow the business this way. So I think Peloton has actually become a much stickier subscription business than it has ever been. And now that it has this massive suite of content, it's much more attractive for users. That's really a flywheel that once it gets going, is really hard for any other company to be able to compete with. I think that's what gives Peloton a leg up and why it's one of the stocks that I have covered on asymmetric investing and own in my asymmetric investing portfolio. The final stock may be a bit of a surprise, but that is General Motors. And this is a company that I don't actually want to own the auto business. I want to own the autonomous driving business, Cruise. Cruise is a subsidiary of General Motors. General Motors owns about 80% of the company, and it's creating an autonomous ride-sharing service. Operational in 3 cities right now. They will add a couple more cities in Texas, likely by the end of the summer. And then they're even launching the Cruise Origin, a custom-made vehicle. It's kind of like a mini bus with 4 seats in it. But these vehicles will be traveling around giving people rides, a little bit like Uber, except there's no driver. So it completely changes the cost structure of the ride-sharing business. And that's really where I think the upside comes from. About 70% of the revenue that Uber generates, it gives to drivers to cover their costs and their time. Well, if Cruise is going to be charging the same amount of money per ride, they're going to take 100% of that revenue to cover their costs and any profits. This should be a more cost-effective vehicle. It's going to be running potentially 24 hours a day. It's going to be custom built for high mileage. And there's not going to be some of the expensive bells and whistles that go into vehicles that you don't necessarily need in a ride-sharing vehicle. So over the next 10 years, I think this could be a massive business. GM actually put a target on this and said that by 2030, they think that Cruise can be a $50 billion per year business. Let me say that again, 2030, so only 7 years from now, Cruise can be a $50 billion business. If that happens, Cruise alone could be worth far more than what we're paying for General Motors today. I think that's where the attractiveness of this stock comes from. You're getting an 80% stake in Cruise, and I don't think that's really priced into the stock at all. So love the upside there from an investment standpoint. This is why it's one of my biggest positions in the asymmetric investing portfolio. So the 3 stocks I think are still great buys today: Spotify, Peloton, and General Motors. I recently added them to my portfolio, which I will link to in the show notes. Check out those deep dives, and of course, subscribe to asymmetric investing. Thanks for watching, everybody. I'll see you here next time.